After 6 years of leading research and hosting daily shows for the #1 options trading podcast, this is one of the most important concepts that I've come to know about the markets. During my 6-year tenure on the research team at Tasty Live, I learned a lot about the markets. My friends and mentors were a mix of quants, data scientists, and former floor traders. And as I spend time on the research team and picking their brains on what they know about the markets and what their experience has been, this is one of the most fundamental truths that I've come to understand about markets and trading in general. Most people misunderstand what it means for the market to be efficient, because most people think that if the market is efficient, it's impossible to make money in the long run. Essentially, this understanding of efficient markets leads people to believe that the market is somehow or another a zero-sum game. A zero-sum game that's analogous to playing dice in a casino or tossing a coin and betting on the outcome. In other words, the concept of market efficiency boils down to people thinking that the market is just some big casino, and over time there's no real way to gain an edge as a trader. In fact, there are even textbooks out there, finance textbooks, that state that if the market was perfectly efficient, then the prices over time and every single day would look something like this. Essentially, whenever a new piece of information comes out, the price instantly changes, but then doesn't really change throughout the day unless there's new information added into it. But obviously, prices don't look like that. They look like this, where the market ebbs and flows every single minute of every single day because people's sentiments and feelings around the price and values of securities always is changing. Because most people think of market efficiency as being that the market has some omniscience to it and that if the market was efficient, all information would be instantly available and the market wouldn't change until new information came out, people tend to discount the fact that the market is efficient because when you look at the stock market, you see nothing but certainty. Everything's always moving, there's so much fluctuation. So most people think, well, how can the market be efficient if the stock market is always moving so much? Now, in order to start to understand what efficiency actually is, we must reject the notion that just because prices ebb and flow, violently in some cases as well, that the market isn't efficient. That's simply not the case. You can have an efficient market alongside crazy volatility, and those two truths will not contradict each other. Although there isn't a universal consensus on how efficient the market actually is, I think it's important for every single trader to have a position or an opinion on this matter because it will fundamentally define the way you approach your trading and strategize in the future. Now, I do think that there are definitionally wrong understandings of market efficiency, and I want to kind of separate that clutter from the rest of the truth so that you can understand better of what it is and what it isn't. The reason it's important to have an understanding of this, at least on a fundamental level, is because if you don't, I believe personally, it could actually hinder your confidence as a trader if you don't fundamentally understand the way the markets operate. So, what does it mean for the market to be efficient? And then, how can I strategize my trades based on this information? An efficient market simply means that all prices of stocks, options, bonds, ETFs reflect all available information and aggregate sentiment around that particular product. The price that you see is the fairest price at any given moment. This means we can also say that an efficient market is also a fair market. Now, why is that important? The reason it's important to know that an efficient market is a fair market is that we will have the confidence to know that the market is not rigged when we go to place a trade. The price that we go when we make a trade is the only price available in that moment. And although there will be fluctuations after we make that trade, we can be confident in knowing that we are not getting ripped off when we take that trade. So that's a bold claim, but the question is, how can I know that that's true? And the answer to that is a tight bid-ask spread. A bid-ask spread is simply the financial jargon term of the difference at what you can buy something at and what you can sell it at. A very narrow bid-ask spread dismantles the possibility that the market is rigged at all. And the reason is because you are able to take either side of the trade at nearly the same price. Now, although this sounds like a really simple proof text, this is the way you can think about it. If I were to offer you a wager on a coin flip, but the stipulations were that you can only bet on heads, and the coin that we're going to flip comes right out of my pocket where I have a very special coin that I use for this, you would naturally be pretty skeptical, and as well you should be. What if I fix the coin that it is weighted to always land on tails? Or what if both sides of the coin are tails? So if you bet on heads, you're going to lose no matter what happens. This is obviously something you should be skeptical of if somebody offers you a wager that seems like they're trying to rig the odds in their favor. However, let's take the same exact scenario, the same exact coin in my pocket, the same exact wager I'm offering you, except for the fact that now the stipulation is you can either bet on heads or tails, and it's your choice. If that were the case, then all the skepticism you had about the coin itself would actually be not relevant at all. And the reason for that is because now you get to choose which side you bet on. So regardless of what kind of coin I'm using, if you choose to bet on heads or tails, the outcome is now determined by you and not the coin that I'm using to flip. This is the exact same thing that happens in our modern day financial markets. The existence of a market where you can buy something or sell something at nearly the same price basically dissipates the whole notion that the markets are rigged. And the reason is because you can choose which side to trade, and if it's the same price that you're going to buy or sell something at, the outcome of the trade has nothing to do with the product that you're trading, but it has all to do with your decision on whether to buy or sell. So now, how does this affect your trading? Well, now instead of looking at the markets as something that you have to beat or overcome because there's some force against you, you can now look at the markets as a level playing field where it's up to you to form a strategy that is profitable over time without worrying about the fact that the markets may be rigged or stacked against you. So the question you're going to ask when forming your strategy no longer becomes, how can I find an edge to exploit some kind of market inefficiency? To now you're going to ask, how can I form my risk tolerance that's acceptable to what I have in my account? Or what kind of strategy can I make where my probability of making money is at a certain level? Or if I know that there's a big move coming in the stock market, or there's some earnings event that's going to affect a particular stock, how can I adjust my exposure to take advantage of the volatility that's going to come from that announcement? How much money would I be satisfied with making relative to the amount of money I'm willing to lose? All of these are strategic questions that now become front and center because you know that fundamentally you're playing in a marketplace that's fair and you don't have to worry about whether or not you're getting ripped off, and instead you can focus on the things that actually matter, which is risk, reward, and setting a probability of profit that is perfect for your trading account. Once you understand what efficiency means, you'll finally be able to stop worrying about being screwed and actually start building a trading strategy that can build your trading career. Hey, thanks so much for watching this video. If you want to see more content like this from us, please like, subscribe, and hit that notification bell so that you never miss a new video when we release it. Thank you so much for watching. My name's been Anton Kulikov, and I'll see you in the next one.